Hello and welcome to the quarterly update for the K2 Australian Small Cap Fund. My name's David Poppenbeek. I'm the Chief Investment Officer for K2 Funds, and I'm going to introduce you to our quarterly update. I'm going to break the update into four parts. Firstly, I'll talk about our performance. I'll talk about the contributors to the performance over the last quarter and also for the last 12 months. I'll then give a bit of an introduction to the backdrop that we're envisaging will assist us in investing in small companies over the coming periods. I'll then give a bit of an update on how the fund's positioned for the backdrop. And finally, I'll end up with an insight into one of our core holdings. So if we look at our performance, we're really happy with how the fund's performed over the last quarter. We performed a little better than the broad market. But importantly, over the 6 months and the last 12 months, we've performed very strongly. Over the 12 months to 31st of March 21, the K2 Small Cap Fund delivered a 69% return, and that's after all fees. And that was nearly 17% better than the broad market. And what was quite important about that year was our average net exposure for the last 12 months has averaged of around 91%. Now, if we consider how the fund's actually performed since inception, which was nearly 8 years ago, on average, the fund has had net exposure of about 76%. So you can see that over the last 12 months, we've been very optimistic about equities and we've been pretty much fully invested. If we think about the top three contributors for both the quarter and also for the last 12 months, it's been very pleasing. For the quarter, our three best performers were Pentanet, Healthia, and Mars Group. Pentanet is a small company that listed in January, and they're a internet service provider. They deliver high-speed bandwidth, and they specialise on servicing the metropolitan Perth market. It's a high-growth business, and they deliver their service over their own infrastructure. So it's a really quite unique model. It competes with the NBN. The business is very much in high growth mode. Over the last 6 months, they've grown their subscriber base by almost threefold, and the stock's done very well. It IPO'd at about 25 cents, and today it's trading around 90 cents. So it's almost a four-bagger for us. So we're really happy with that company. It's small, but it's performed very well for us. Another stock that performed well for us is Healthia. Now, Healthia is a service provider to the healthcare industry. They deliver services such as podiatry, they deliver physiotherapy services, and also optometry. It's a very, very large marketplace, and the market is very, very well fragmented. Healthia is growing nicely. We think that they've got a very long runway of growth, and the stock's very attractively priced. So even today, after performing as well as it has, it's trading on 12 times forward earnings, and we think that it can comfortably do 20% earnings growth over the next couple of years. Finally, Mars Group was our third best contributor for the quarter, and this is another IPO. They listed in December, and it's a business that is heavily leveraged to infrastructure spend in Australia. Mars Group have a number of businesses. Firstly, they have construction materials. They also do civil construction and hire, and they also are involved in underground mining and services. And the final complement to its businesses is a property division. Mars Group's got a wonderful culture. We were very attracted to the management team when we first met them about a year ago. They're very invested. They have a very strong cultural background. The founder and his management team own the majority of the company, and we think they're really well positioned to continue to grow as the Australian infrastructure spend continues to build out over the years ahead. When we think about the top three contributors over the last 12 months, interestingly, all three of those companies more than doubled in share price over the last year. So the best performer for the year was a company called Somerset. Now, Somerset is one of the leading developers and operators of retirement villages. And that's the company that I'll actually give more detail on later on in the presentation. But it performed very well for the year. As a little bit of an entree, we knew that COVID was going to be a pandemic that really affected the elderly. And Somerset has about 8,000 residents and staff under its watch within its retirement villages. And despite COVID, they didn't have a single case. So needless to say, the stock did very, very well over the year. People Infrastructure was our second best contributor for the year. A really, really interesting business. They're involved in workforce management. They're focused on delivering solutions to the healthcare industry and communities. They're also heavily involved in providing staffing solutions to the IT sector. And finally, they're quite involved in staffing solutions for SMEs. It's a very, very large addressable market, nearly $30 billion, and People Infrastructure at present have got less than 2%. It's very well run. The owners and board, or the management team and board, are quite heavily invested in the company. And we think at 15 times, with an ROE of near 30% and no debt, we think that People Infrastructure has got many years of growth ahead of it. To top off the year's performance, Net Wealth also doubled in share price for us. Net Wealth is a specialist investment platform provider. They're the number 7 player in a $1 trillion marketplace, and they've been consistently winning market share. They're the leading recipient of inflows in the space, and they're competing against the 3 major Australian banks and AMP. They've been consistently winning share. Over the last 12 months, their funds under administration grew by 50%, and they're very well positioned to continue to win market share. So given how the funds performed over the last 12 months, I think it's important that we give you some sort of insight on how we're thinking about the trading conditions that we expect to underwrite our portfolio. And we think that it's worth having a look at how small companies in general have performed over not just the last 12 months, but over the last 30 years. And we still think that there's some catch-up that's due for small companies. When we look at the way that small companies have performed over the last 30 years, they've actually underperformed the larger companies, being the ASX 100, by around 2% per annum. And that underperformance really did accelerate post-2011. There was a decoupling. From the European debt crisis, in actual fact, the small ords underperformed the ASX 100 by 4% per annum. So over a 30-year period, investors would have been far better off being in the ASX 100. They got 60% more returns. However, we think that there's some real opportunities for a lot of catch-up for small companies, because that breakdown in performance since 2011 was really due to a couple of structural events that impacted the earnings profile for small companies. Earnings momentum is something that you need if you're going to perform in equity markets. And since the GFC, small companies in Australia have seen a 40% reduction in their expected earnings profile. And when you compare that to what happened with the ASX 100, their earnings are actually 40% stronger. So with that sort of backdrop, it's very hard for small companies to outperform. However, we think there's been a couple of really important structural issues that we've got to consider. The first thing was that when the GFC occurred, global banking regulators decided that they needed to preserve the payment system. And what they did was they ensured that banks globally had to put more capital behind every loan that they made. Now, what that did was it meant that banks prioritised who they lent money to. And the regulations really favoured large companies. So what effectively happened was that banks around the world were happy to lend money to large, safe corporations at really advantageous rates. Small companies, on the other hand, there was a scarcity of capital. And if they did manage to get banking capital, it was at rates that were much, much higher than what the leading companies had. And that had an impact on earnings. And you can see that with the earnings profile for the small companies, it's really ratcheted down. And in fact, if you look at the earnings profile for the small companies in Australia, they're 50% lower than what they were pre-GFC. When you look at the ASX 100, they're only 20% lower. So we think from here, there's a lot of earnings momentum that's going to support small companies looking forward. We also think that economic conditions are going to help small companies. Now, we looked at conditions over the last 30 years, and what we noticed is that there were three very important phases where the broad economy was improving, interest rates were rising, and small companies outperformed. Each of those three periods, which is in the green shading there, on average lasted for about 3 years. And small companies during those periods, on average, outperformed the large caps by around 30%. So where we sit today, we think that the Australian economy will broaden. We think that activity will continue to improve. And ultimately, we think that interest rates will start to gravitate higher. And that backdrop, we think, should greatly favour small companies over the years ahead. And we think that they're destined to outperform. So how do we position ourselves for that sort of backdrop? Well, we remain pretty well fully invested. But there are a few little interesting things underneath the hood. You'll notice in the industry breakdown, we're quite underweight basic materials. Now, in the Small Ords Index, basic materials, the exposure tends to be explorer-based, and we're not geologists. So that's a part of the market that we're not really all that comfortable investing a lot of money in. However, you'll also notice that we're very overweight financial services. And this is a part of the market that really does prosper when asset prices rise. And that's what we think is going to happen over the next couple of years. Now, it is worth pointing out that our portfolio is not constructed on a top-down view. It's all driven by our bottom-up stock selections. And it just so happens that at the moment we are very overweight financial services, and I think that'll continue for the next year or two. The other thing worth pointing out is that we have the capacity to short sell, but we have no shorts on at the moment. The reason for that is that we think that the equity market conditions really favour being long, and we want to focus our attention on finding the very best investment opportunities that we can. Now, we think that shorting opportunities will prevail in time, but for the foreseeable future, we are really focusing on staying long. You can see that our net exposure at the moment is around 92%. Now, recall that since inception, our average net exposure has been around 76%. So we've had the best part of 26% of our exposure over the last 8 years in cash. Today, it's only 8. So that really does give you an indication that we are optimistic about markets, and we're particularly optimistic about our portfolio. Where we differ is quite important. The Small Ordinaries Index in Australia is quite a fragmented index. There's no company that's got a larger weight than 3%. And you can see that the top 10 companies in the Small Ords account for less than 15% of the broad market. We, on the other hand, have more than 50% of our exposure in the top 10 companies. We own about 46 stocks at present, and it's a high conviction portfolio with a very high active weight. Now, I think it's worth spending a little bit of time outlining one of our key companies. I mentioned Somerset earlier in the presentation. It's our largest holding at the present. So I think it's important that we give some sort of insight into why that company is such a large weight. Now, as I said, Somerset is one of the leading developers and operators of retirement villages in New Zealand. The company was formed about 25 years ago. And the whole premise for the existence of the group was to provide retirement living for people like one's parents. And the company's origins, they really wanted their parents to feel proud of their home, to feel safe within the retirement village. The management team are very engaged. They have a very strong value bias, and that helps build the culture of providing retirement services. And also importantly, the management team has driven a very strong, a really strong sustainability view of the future. They're one of the first adopters of ESG, and they continue to improve their ESG footprint. The macro backdrop for aged care in Australia and in New Zealand is very, very strong. The baby boom phenomenon means that over the next 30 years, the elderly population will grow at twice the rate of the broad population. And that really underwrites 3 decades of growth through a business like Somerset. The business is not expensive. We believe the PE of this business is a little less than the broad market. And we think that there's really, really strong earnings momentum behind this business. Over the next, 2 or 3 decades, we think that this company can really deliver double-digit earnings growth for a number of years. It's also worth pointing out that Somerset has expanded beyond the New Zealand shores. Just over the last 12 months, they've acquired 3 sites here in Melbourne. And we think that the opportunity set in Melbourne could ultimately be as large as the entire New Zealand portfolio that Somerset's got. So we think it's got very, very strong growth ambitions. It's well positioned, and we think that they'll continue to improve on the profitability sense. Well, that's really all I've got for you today. I guess the main conclusion is that we've had a very, very strong 12 months of performance. We think the conditions over the next 12 months and further out is going to be advantageous for small companies. We're really excited about the portfolio that we've put together at present, and we think looking forward the performance is going to be strong. So in conclusion, thank you very much for your time, and I look forward to speaking to you all in 3 months' time. All the best.